What if you could buy a home right now with a mortgage interest rate of 4%, 3%, or even less? Might that make you more eager to buy a home in this challenging real estate market? Or how about this scenario? What if you put your home on the market and were able to offer someone who buys it a 3 or 4% interest rate on their mortgage? With interest rates topping 7% right now, do you think that might make your listing a little more popular with potential buyers? The real estate market has shifted radically in the past 12 to 18 months. Today, I'm going to show you how to win in this market because I'm going to share some super valuable tools that most people don't even know how to use. I'm talking about loan assumptions. To put it in simplest terms, a loan assumption is when a home buyer, as part of their purchase, also takes over or assumes the seller's existing home mortgage. When you assume a mortgage, the loan terms usually don't change. I'm talking about things like principal balance, repayment period, and most importantly in today's real estate market, interest rate. Back in the 1980s when mortgage interest rates got as high as 18%, loan assumptions coupled with something called a wraparound mortgage helped keep the residential real estate market afloat. Some historians claim this kind of creative financing accounted for more than 50% of all home sale funding in most U.S. markets in the early 1980s. Now that interest rates are once again on the rise, loan assumptions are making a comeback. So stick with me and I'll tell you the basics about loan assumptions, some things to watch for when considering an assumption, and the vital nuances for each of the three main loan types that allow assumptions. Stick with me until the end of the video and I'll explain how even though they are technically prohibited in the loan documents, some people are still doing non-assumptions on conventional loans. Let's start by talking about loan assumptions in general. As I mentioned, a loan assumption happens when the buyer takes over the seller's mortgage as part of their purchase of the property. This practice benefits buyers when interest rates are high and the buyer is able to assume a loan with a much lower interest rate. Sellers benefit because their assumable loan can become a huge marketing tool to generate more interest in their listing by attracting buyers looking for a lower monthly payment. Here's a few things you need to know. Number one, the most important question in a loan assumption is who has liability for the loan? You must ask this question because even though they have sold the property and signed their loan over to the new homeowner, in some cases, the seller retains liability for the loan balance if the buyer defaults on the loan. Number two, the loan assumption is processed through the existing mortgage servicer. The new buyer's creditworthiness must be approved by the servicer for the assumption to be approved. Number three, an assumption can save the buyer money because when you assume a loan as part of your home purchase, your closing costs are often lower than if you apply for a new mortgage. Number four, you assume the current loan amount, and this can be problematic. If the seller has significant equity in the house, the buyer will have to come up with the difference between the loan amount and the purchase price of the home. This means the buyer likely will need a higher than usual cash down payment or a secondary loan to cover the gap between the loan amount and the purchase price. This is where the wraparound mortgages I mentioned earlier came into play in the 70s and 80s. Number five, make sure your contract clearly spells out what will happen to the loan's escrow account. If you're selling the house and this is not addressed, your escrow account and any money in it could end up assigned to the buyer along with the mortgage. Number six, make sure the real estate professionals helping you with your loan assumption really know what they are doing. Amateur mistakes made in the assumption process could cost you a ton of money. And the wrong mistake even has the potential to destroy your credit rating. Conventional loans are almost never assumable, but as I mentioned earlier at the end of the video, I'll address how some people are getting around that. Government-backed loans, FHA, VA, USDA, or RD, those are all government-backed loans. Any of these loan types normally qualify for assumption, but be careful. The conditions and processes are different for each kind. How favorable the assumption is to buyers and sellers can vary by loan type. I'm going to take a quick look at each kind of assumption and share a few things you need to know about each one. Here's what you need to know about loan assumptions on USDA or rural development mortgages. Number one, USDA assumptions are the only government-backed loans where the servicer, in addition to the assumption, can approve supplemental funding to help cover the gap between the loan amount and the purchase price. This is great for buyers because they may not need as big of a down payment as they might for loan assumptions of FHA or VA loans. Number two, the buyer must meet all USDA loan eligibility requirements, including any income limits. Number three, USDA assumptions are not a great deal for sellers because the guidelines say that when the seller assigns the loan, he or she, quote, must remain liable for the debt and must acknowledge continued liability for the debt in writing. This means the seller remains on the hook for any loan balance if the buyer were to default anytime after the loan assumption. If you're a seller, you should probably avoid USDA loan assumptions unless you're desperate or it's the only way to avoid a foreclosure. And even in those cases, you should be extremely careful before allowing anyone to assume your USDA mortgage. Here's what you need to know about loan assumptions on VA mortgages. Number one, the VA loan assumption processing manual was completely revised on April 1st, 2019. That means anything you thought you knew about VA loan assumptions before 2019 should be thrown right out the window. Number two, in addition to assuming the loan, the buyer assumes all loan obligations, including the obligation to indemnify the VA if a claim is paid. In plain language, this means that the buyer becomes a substitute borrower for the seller, and the seller is released of all financial liability for the VA loan following the assumption. However, one caveat, make sure the sales contract includes language spelling out this provision. All right, number three, veterans who allow a buyer to assume their VA loan may lose all or part of their ability to qualify for future VA loans until the assumed loan is paid off in full and retired. The selling veteran may be able to retain his loan entitlement if the buyer is also a veteran with sufficient entitlement and completes a substitution of entitlement. Needless to say, any veteran thinking about offering an assumption of his or her VA loan should carefully consider all of his or her rights and responsibilities before making that move. Here's what you need to know about loan assumptions on FHA mortgages. Number one, the HUD Reform Act of 1989 states all FHA insured mortgages are assumable, even when the loan paperwork says otherwise. The 1989 Act also says, and this is a direct quote from HUD 4155.1 in the handbook, quote, private investors are prohibited from assuming insured mortgages that are subject to restrictions of the 1989 Act. This restriction applies whether or not there is a release from liability by the lender of the selling mortgagor, end quote. I've run into many folks who claim investors can assume FHA loans, but this statement directly from HUD seems to say otherwise. If you're an investor, you should tread lightly when it comes to FHA assumptions. Number two, FHA allows the buyer to use secondary financing to help cover the gap between the loan amount and the purchase price. However, that financing has to be disclosed to the servicer during their creditworthiness review of the buyer. And number three, just like with VA loans on FHA assumptions, the seller is released from all liability following the loan transfer. Also, just like with VA loans, make sure the sales contract includes language spelling out this provision. Now let's spend a little time on conventional loans. It's nearly impossible to find a conventional loan that allows an assumption. That's because conventional loans have what's called a due on sale clause. It can also be known as an acceleration clause. These are provisions written into the loan agreement that give the lender the right to declare any outstanding loan balance immediately due and payable should the loan or underlying property ever be sold or transferred without the lender's prior consent. So let me be clear, except in the rarest of circumstances, lenders do not want their conventional loans to be assumed by any buyers. And those lenders have tools at their disposal to go after sellers who attempt to assign their conventional loan to someone else. Having said that, there are people out there who claim they are assuming conventional loans. But here's the truth. Those folks are not actually doing a legal assumption of that loan. They're doing what some people call a subject to purchase of the home. These investors have the seller sign a deed, transferring ownership to them, and then the investors begin making payments on the seller's mortgage. The mortgage company is never informed of this property transfer, and the seller's name remains on the loan until the buyer pays it off. This means the seller has signed away all rights to their property while at the same time retaining all liability for the loan on that property. This is a bad deal for sellers, and they should avoid at all costs ever getting themselves into this situation. Once the transfer of title on the house is complete, the lender has the right to invoke their due on sale clause at any time. If that loan is called and the buyer is unable or unwilling to pay off the loan in full, the seller is on the hook for all that money, and the seller is the one the mortgage company will foreclose on if no one is able to cough up the cash. I'll say it again. This is a bad deal for the seller. Whatever your real estate situation, we're here to offer our advice and expertise. Give us a call or send us a text on our real estate hotline, and we'll help you out.